Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. These are the top headlines that we're tracking at this hour. Markets are recovering from the lowest point of the day, but trade with a negative bias. The Nifty tests the 11,300 mark, and the Nifty Metals Index is the top sectoral loser. After leading the losses for the last 3 days, HDFC Twins are lending support to the Nifty. Contribution is almost 27 points to the upside. Zee Entertainment is the top gainer on the Nifty after the management said that 2 foreign bidders have shown interest in buying the promoter's stake. And Asian Paints trade with gains after reporting a beat on all parameters in the first quarter numbers. The domestic business registered a double-digit volume growth. Good afternoon, Neeraj. Some respite. We're off the day's low, but Nifty still trading below the 11,300 mark, which we were defending in the last 3 to 4 days.
Yeah, and Navneet, I mean, one look at the Asian screen this morning, one would have hoped that this wouldn't be the case. Sadly, we are sub 11,300. Let's see. Maybe if you talk to any technical expert, the person will tell you that it's not necessary that if an index has broken a particular level, it can't bounce back immediately. It could. It needs to stay below a particular level for a considerable period of time for it to have broken that support and then headed lower. So let's wait and watch what happens. Banks are playing sport today, so that's interesting. And the Sensex and the Nifty have a bit of a disparity in the way they have moved to. But the Nifty Bank, 0.17%, is not doing all that poorly compared to the Nifty, of course. Bring up the heat map and show what's moving there. Amongst the large cap space, the market breadth has turned completely on its head. It was a mirror image of this at the start of the trading day, now more red than green, and a clutch of names wherein the selling has just been incessant. So iShares continues to grind lower. It's now at 16,000. It's nearly half of its 52-week highs, and that's quite something for what is considered and touted to be an iconic brand, but down about 4%. Hindalco, JSW Steel, that whole metals pack. Tata Steel is contributing on the downside. Britannia from among the consumption pack is also down in trade. And we also have IndusInd Bank losing out today. It's just, maybe 3% away from its recent lows that it hit before the results came out. So, all those gains have been sold into. Bajaj Finance, another 2.5% down. And that also speaks volumes. I think financials and selectively some of these financials, corporate-facing, consumer-facing financials are correcting. Zee's had a fabulous move. Now, this has to be in anticipation of what the management said yesterday about a deal coming in, maybe a binding term sheet, maybe the deal gets signed at a higher price. You can probably see the reason for this. And the Asian Paints and HDFC, Asian Paints on the results and the big boy HDFC helping hold the index up. But it's Asian Paints and Zee Entertainment, the 2 winners of the session thus far. But if large caps have corrected thus far, mid caps can't be too far behind the winner. How's the scene looking?
Yeah, unlike yesterday's session when you actually saw a very divergent move within the mid caps and the small caps, today's session, though not as much as we would have seen in yesterday's trade, but you are still seeing pockets where there is, an incredible amount of weakness that has come about for some of the stocks. Just want to quickly highlight a few stocks which are in focus on the back of results. M&M Financial for one, that stock has taken a big heavy knock of about 8.5%. We've seen the results, and obviously the space is witnessing some amount of pain, grappling with pain. Even in the coming few quarters, the outlook is not all that positive. The stock's down about 8.5%. Jubilant Foodworks not reported numbers yet, but that's going to be an interesting watch to see what comes out from the consumption space. In light of what the rest of the pack has been doing, we've just had Asian Paints numbers getting reported, and it has beat the street expectations. Don't know whether Jubilant Foodworks will be able to do that or no, but seems to see as growth expected to come in at about 6%. So let's see what that one does. It's coming on the back of a really high base, by the way. Stocks on the move. Torrent Pharma, 32% increase in net profits reported yesterday, and the stock is rewarded for that. Expansion in margins as well. Indiabulls real estate is up about 4%. And Sign, finally, after seeing some incessant selling, has finally managed to bounce back a little bit, and that's up about 2% at 487. Other stocks on the back of volumes. Group Finance, for one, has looked weak in today's session. 7.5% being sold on the back of about 9.5 lakh shares that have been traded. Bandhan Bank, 437. Remember, numbers were not all that bad, but yet, we're talking about them mainly focusing on those smaller ticket loan sizes, which probably may not be able to make them go the whole hog in terms of the overall growth over the next few quarters to come, unless and and until they start looking at bigger accounts. Then you've got GSPL, which is up about 7% as well, down about 7% on the back of volumes. Kajaria Ceramics, a big knock. You've got Sterlite Tech and Orient Cement, some of the other names on the back of volumes which are losing out. And stocks near their 52-week lows. You've got a Lemon Tree, which is very close, in fact at its 52-week low right now, so 62.85, 52-week low there. Oil India 155, that's its 52-week low, and IDBI Bank 31.65. I think it made that and then it's come off there. So in today's session at least, I think all three of them have made new 52-week lows. But what's happening in the more liquid universe in the futures and options space? Today we're 1 day away from the expiry of the July series. Navneet, what's the setup like?
Well, Davina, thanks for that. If you look at the futures and options space, we have seen some bit of build-up coming in when it comes to the open interest of both Nifty as well as the Bank Nifty futures. Remember, so far this series has all been about unwinding, which is turning out to be the worst series of 2019. But even the July futures of Nifty are seeing OI build-up of about 6%. And of course, the rollovers this time around have been just mildly above the 3-month average, at least till yesterday. And right now, the Nifty rollovers are at about 48%. Let's pull up Bank Nifty as well. Remember, the markets are off the low point of the day, but still we are seeing some bit of cuts till now. Bank Nifty is trading around the level of 29,000, and look at the July open interest, it's up 26%. Let's see how much of this lasts by the end of the session, because this could be also these could be intraday trading bets as well. The volatility index, which has been moving higher with the markets falling in the last 3 to 4 sessions, finally some cool off coming in for India Wix, which was up in the morning session, inching very closer to the mark of 14, is right now sitting at levels of about 13. Options data for tomorrow's expiry, maximum open interest on the call side happens to be at 11,400 now. Okay, it's shifting between 11,300 to 400, and on the put side it is at about 11,300. So what's the range you should watch out? A lot of call writing came in at the 11,300 level, which has been breached in today's session, and for 11,300 put, after the index fell below that mark, the put writers went for cover. So even the 300, 400 put strikes have seen unwinding. Positions are now active on the 11,250 put strike, which is added about close to 11 lakh shares. So I've been observing the 300 and the 400 call and put strike, where the combined premium in last 2 days has been somewhere about 100 points. Remember, it will of course come down because of time decay. That's giving you the range for tomorrow between 11,150 to about 11,350. And of course, the base has been coming down in the last few days as well. Stock futures, Torrent Pharma, we've highlighted the stock in the morning as well. It snapped the 5-day fall, posted some numbers which were good. The margins went up for the first quarter. It's moved above, by the way, its 50-day moving average. It's gone up on good amount of volumes as well on the cash side. The AV80 function of Bloomberg will typically project that. So the white line is projecting today's volume vis-a-vis the average volume of last 20 days. That's a good sign if the stock goes up on good amount of volumes. Zee Entertainment, your top gainer in Nifty, reacting positively to earnings. This one too has moved above its 50-day moving average. We are seeing some long positions coming by for Zee Entertainment's future. M&M Financial is the other one, which is down 13% in last 2 sessions. It's of course reacted to its earnings, where asset quality has deteriorated and profits are down almost 74%. The stocks also touched its 52-week low, and aggressive shorting seen for this counter for the second straight session.
FMCG stocks that have reported earnings thus far showcased mid-single-digit volume growth, but the commentary is what we want to focus on, as most companies have guided for the second half of the fiscal to be better than the first half. Let's discuss this with Kaustubh Pawaskar of Sharekhan. He joins us right now on the show. Kaustubh, thanks much for joining in. What did you make of the commentary thus far? Because the market seems to be, kind of not quite settled in. Dabur disappointed, HUL a mixed bag here and there. Some of the smaller companies thus far, you don't quite know if they're confident or if they're hopeful.
I think quarter one, I think volume growth of mid-single digit was largely anticipated, because most of the companies during their quarter four result in their commentary has mentioned that they have started seeing slowdown in the rural market, and that was supposed to be continued in Q1. So Q1 mid-single digit kind of a volume growth was more or less anticipated. However, Dabur surprised us positively by posting 9.5% volume growth. But in the commentary they mentioned that the fag end of the quarter, June, the industry growth was somewhere about 6-7%, and volume growth further moderated to 4%. So that is something which is kind of a worrying, because Q2 according to us will be another subdued quarter, and volume growth would be about 4 to 5% for most of the companies. That is what our understanding is.
Okay, Kaustubh, just to get in a sense from you, while obviously, these numbers are nowhere compared to the volume growth numbers that we've seen in the previous years, but do you think things are normalizing now? Because for most of them, even Colgate for that matter, came in line in terms of the volume growth. The others as well that reported numbers. HUL was a miss by 1%. You think that there's some sense of normalization that's coming back into most of these consumption names?
See, I think the basic consumption items, I think I don't think there is any downtrading or there is a cut on the consumption. So I think those categories would continue to do well. The only issue is with the premium categories where we have seen some downtrading, or there is a cut on pack sizes. So there might be some slowdown in those categories. For example, in HUL results, we have seen home care performing well with double-digit volume-led growth, while the personal care, the growth was muted at about just 4%, where personal wash didn't do well during the quarter. However, companies have taken actions. We have seen HUL reducing the prices by about 4 to 6% in their some of their popular soap brands. Even its competitor has taken the pricing action. So I believe the benefits of lower raw material prices have already been passed on to the consumers, and I think we should see sales volume of the soaps category or some of the key categories to be stable going ahead. But Q2, I think the growth would be more or less moderated if monsoons are good, if government provides some pushbacks. I think that would result in better performance in the second half of the year.
July, though, we're still a bit deficient with regards to the monsoon, so I don't know how that will play up in the upcoming months. But, we've got Jubilant Foodworks that's due to report its numbers too, Kaustubh, and same-store sales growth, that's something that's going to remain in focus. Last quarter had about 6% expectations, or somewhere closer to that itself, but nowhere close to what we've been seeing in the previous quarters to the tune of 20%. That's going to take some time to follow through. But what would you be expecting out of Jubilant, and what would be a good enough number for you?
I think 5 to 6% same-store sales growth is quite decent, because we have to consider the high base also. And the second key point is that Jubilant have started adding stores in the vicinity of some of its mature stores. So there would be some calibration of sales happening in the mature stores. So I guess that impact would be there for some quarters. So I think 5 to 6% same-store sales growth is quite decent. From the margins perspective, I believe that we should not expect any significant jump in the margins, mainly because of the fact that the company has recently got into the Chinese cuisine segment, and I think they would be doing a lot of investment, which might eat up margins for some quarters. So margins would be flat, or there might be 40-50 bips improvement. But in terms of same-store sales growth, if 5 to 6% same-store sales growth comes in quarter one with about close to double-digit revenue growth, I think that would be a decent quarter for Jubilant.
Just, one question with regards to the management commentary so far. Obviously, we've heard much of it in the last quarter itself with regards to the slowdown. So there's nothing new that they've spoken about in terms of this quarter and what the outlook for the future holds. But do you believe that there could be a meaningful turnaround anytime soon? And by when do you envisage that happening?
See, as I said, that monsoon is going to be key. As of now, only 50% of India has received monsoon, and most of the other, the other part of the India is yet to receive monsoon. In fact, it is deficient out over there. So July has almost been, it's in verge of over. So if August, September, if we see, somewhat normal monsoon, I think that would be breather for the rural economy. Also, government, they need to take some actions. They have already taken some actions, but I think those actions need to play for the rural economy to see improvement in the rural demand. So I think, if all those things are in place, I think Q3 should be one of the key quarters for the consumer good companies, because even festive season would be around the corner. So we normally see, consumption increasing during the festive season. So I think Q3 would be one of the important quarters for consumer good and consumer discretionary companies.
That's right, Kaustubh. In fact, the management of HUL clearly highlighted as well that they do expect a revival in the demand environment in the second half of this fiscal year. Having said that, Kaustubh, have you observed any sort of similarity so far with the numbers which have come out with regard to ad expenses for Dabur, HUL? Both of them, ad expenses have been on the lower side. And of course, looking at the ad revenues of Zee as well, we've seen the ad revenues not picking up because the companies are not spending too much. And they've highlighted as well the spends from the FMCG companies were on the lower side. Do you see this trend continuing? Because in an environment where demand is weak, at least these companies are trying to protect their margins by cutting down on cost.
See, what we are getting from the company is like, when there is a weak demand environment, normally the competitive intensity is low, and there is not much requirement to go for higher advertisement spends. So normally in weaker demand environment, the small brands, regional players, they are not active much to go into the market with best offers or higher sales promotion activities. So I think that is the case where large companies like HUL, Dabur, they have their that benefit of not to increase their advertisement spends, but do it in a judicious manner. However, the promotional offerings are still there in the market. We have seen that, but going ahead, we believe that advertisement spends would remain flat, or there would be marginal increase on YY basis. But if we see demand environment improving, I think the advertisement spends would also go up.
Okay, Kaustubh, before we let you go, and thank you, what are your top picks in the FMCG space?
See, we like Hindustan Unilever mainly because of the fact that it is a large FMCG player, and it will benefit from recovery in the demand, especially in the rural markets. Already it has a strong product portfolio, and with GSK's acquisition, I think its business, its food business will do well. It will have a strong product portfolio in its food business. So I think HUL is one of our topics. We like ITC as well, mainly on account of its discounted valuations, and we have seen that for last few quarters we have not seen any increase in the tax on the cigarettes. So I think that augurs well for ITC's cigarette business sales volume. So I think ITC is another stock. And we also like Marico mainly because of the fact that this year Marico's earnings would grow with margin expansion as copra prices are lower on YY basis. So that benefits are there, and with copra prices down, I think most of its benefits would be passed on to the consumers, with some pricing actions been taken in Parachute and other key brands. So I think though we might see revenue growth maybe in high single to low double digit, but I think margin expansion would help Marico to achieve double digit kind of earning growth.
All right, Kaustubh, we'll leave it at that. Thanks very much for joining us. Appreciate you taking out the time. That's a quick view on what's been happening within the consumption space and all the numbers that have come out so far. And talking about consumption space, Asian Paints has surpassed estimates in the June quarter. New accounting standards have boosted margins, but how was the overall business performance? Yash Upadhyay, he's joining us right now to tell us just that. Yash.
That's absolutely right, Devina, because Asian Paints has not disappointed the street. It had been running up ahead of the results, and it is up 3% today as well after the numbers came in far higher than what the street was working with. Their revenues grew 17% to 5,131 crore rupees versus expectation of 4,886. Net profit is up 18% at 655 crores. EBITDA is also higher by 25.5%, and margins, they have come in at 22.5% versus 21%. Same time last year. Now the key number to note over here is the volume growth in the domestic decorative paint business. The expectation was in the range of 9 to 10%, or even at the higher end somewhere around 11 to 12%. But the management has come out and said that the volume growth has been far higher. In fact, they don't give a specific number, but they have said that the volume growth has been in the high double digits. So it is likely that that number could be in the range of 14 to 15% as well, which is substantially higher than even the most bullish of the brokerages which came out with the estimates. The raw material situation, that has improved considerably. So the raw material costs, that moves with a 1 quarter lag. We saw last quarter what happened when the higher crude oil prices, that impacted the margins coming down to as low as 16.5%. The expectation was that it would be around 18.5% because of higher sales of putties and distempers, but it has managed to beat that expectation, and in fact on a year-on-year basis we have seen a growth. Now do keep in mind that there has been some benefit that has come in on account of the Ind AS changes, but even if you take out the 51 crore rupees in the EBITDA, or 1.2% on the margin basis, even then the number would be higher than what the expectation was. So a key positive when it comes to that. The depreciation cost amongst the monitorables has increased by as much as 42% on a year-on-year basis to 193 crore rupees. Now this, I understand, is on account of their new plants that have come up in Mysore and Vizag. So that is why we've seen the increase in depreciation costs. In terms of management commentary, they have said that the automotive and the industrial coatings business was subdued in the quarter gone by, and that would be something which wouldn't be a whole lot negative for Asian Paints because it accounts for less than 30%, but something to watch out for when it comes to Kansai Nerolac.
Okay, Yash, thanks a lot for bringing that review of Asian Paints line by line beat on all parameters by the company. Stock 2 trading with gains of about 3%. Moving on, Zee's earnings surpassed analyst expectations, gaining a boost from higher subscription revenue, although advertising revenue remained muted for the quarter. Yatin Mota joins in to tell us how the brokerages are assessing the stock after the first quarter numbers. Yatin, over to you.
Afternoon, Navneet, and as we know, we had a 47% kind of a growth on the subscription front, and the ad revenues for Zee grew by nearly 4% on a year-on-year basis. If you look at the brokerages, most of them have maintained a buy with the target price little unchanged. CLSA says that they are maintaining a buy with a target price of 515. They say that the first quarter beat was largely driven by the strong growth in the subscription revenues. Of course, as far as the progress on promoter stake sale is concerned, that will be the key catalyst for the stock moving ahead. Of course, content costs are increasing, and Z5 ramping up is something that they'll be monitoring moving ahead. Credit Suisse has increased the target price of Zee by 10 rupees to a level of 400 rupees. They also believe that the subscription growth, because of which there is a bulk part of a beat in the earnings. The conversion of free-to-air channels to pay has impacted reach, and hence advertising for most of these media and entertainment players. And more importantly, the key takeaway from Credit Suisse is that the Z5 ramp-up is lower than expected, though it's only early days in operations, probably 18 months only, and the maturity of this business would be something interesting to the investor community.
All right, Yatin, thanks a lot for bringing all those details. Well, fundamentally, everything seems to be fine, but the key catalyst for the stock going ahead would be the promoter stakes sale. Zee, by the way, reacting to its numbers today, is up about 4.5% at levels of 377. Since we're talking about individual stocks which are reacting to their numbers, one stock that has had a bit of a rough ride off late, and that's Kajaria Ceramics. Though the quarterly numbers were average, what the street has not taken too kindly is the downward revision of its revenue and margin guidance. The company has revised its revenue guidance to 12 to 13% from the earlier guidance of 15% plus, while the margin margin guidance too has been toned down to 15 to 16% from an earlier guidance of 16 to 17%. Well, as a result of which Edelweiss has downgraded the stock to hold. Let's discuss their rationale behind this move. And joining us now is Rohan Gupta of Edelweiss. Hi Rohan, good afternoon to you. Looking at the numbers, I guess, which were pretty much okay. Realizations were on the lower side, volume growth of about 9 to 10%. What's triggered the downgrade to hold rating? Is it the financials which have come out, or you don't expect any sort of improvement in the demand environment within the real estate segment?
Yeah, hi, good afternoon. So yeah, definitely for the current quarter numbers, we don't see that was any disaster number. It was pretty much in line what we have estimated, but I will say that the overall outlook, and especially in the near-term outlook, which is coming from the real estate weakness across in the economy, we are seeing that is leading this kind of a reaction in the stock. We have also downgraded. We are seeing that there will be very slow pickup in the market and the demand environment with a very limited pickup in real estate. We are seeing the competition, especially coming from Morbi, still remains at a very high. Morbi has taken some price increases earlier because of NGT ruling, that is because of the switching over to gas. That benefit, I think, is also slowly waning away because there is a continuous competition. So yeah, there is a slight dip in guidance from the management, but in my view that this is a more macro call which we have taken, that the recovery in the near term is still far from reality.
Okay. Rohan, looking at the building material space, this was one stock which was liked by majority of the brokerages. And of course, being an organized player, it was an undisputed leader, as mentioned in your report, commanding higher multiples. So looking at the entire sector now, considering the demand environment as highlighted by you, do you then expect a D-rating going ahead for the entire space?
Yeah, definitely we are not looking at the D-rating of the space, and mainly for the leaders like Kajaria Ceramics. That's why we are saying that these companies will continue to trade a higher multiple. It's all about the slight pressure on earnings, which we are factoring in our current target price, and that's why the downgrade happened. It's more to do with the earnings. Why we are saying that the multiple D-rating is unlikely still, because if you see in the last 2 years, Kajaria has been continuously reporting a double-digit volume growth. It is mainly coming from the market share gain. We are still very much confident about the market share gain will continue, and the switch from unorganized to organized, which was supposed to happen in the economy, is just only continuously getting delayed every quarter. But Kajaria has been maintaining its leadership and will continue to gain market share. That's our thesis and thought process is. We are still looking at the consolidation to happen in the industry, but switch from unorganized to organized is just getting delayed, which is affecting the industry competition and limiting the price increasing power of all these companies. And that's why we are saying that margins may not be able to improve so much in a near term.
Rohan, the realizations, I believe, were lower despite of the company increasing prices. Do you see this trend continuing where realizations could be under pressure for the remainder of the year as well?
No, actually that is not the case. So you see that definitely the current quarter is a slight dip in realization. They have reported 10% volume growth, and realization was minus 3%. That's why you're seeing top line growth of 7%. It is more to do with the product mix change. That is pretty normal. It happens on every quarter. This quarter we have seen that some of the project sales has been delayed. Some of the orders have been delayed because of the election time. So there has been some change in a downward trend. Downward change has happened in a product mix, which I believe that will definitely pick up. Price increase definitely has been there, but has been very small price increases has happened in a volatiles category. Some price increase has further come in month of July. That benefit of that we should be able to see in upcoming quarter. So we are still confident about actually the company growing by almost 12 to 13% in terms of revenue growth, which will be on a back of 10% volume growth and 2 to 3% price increase and product mix change that we see that will be visible in next 9 months. Problem is more towards the margin front, where we were expecting that the margins will continue to improve, but there we see that there is a limited pricing power, or there is a increased competition is probably keeping the margin continuously under pressure.
Well, the stock's been under pressure, Rohan, for the last 6 sessions. Before we thank you, do you see any threat of not meeting the revised guidance as well, which the management has given on the revenue as well as the volume growth?
On that guidance, I see actually very less risk because that it's anyhow showing only just 12 to 13% revenue growth, and we see that 9 to 10%, even current quarter also they have delivered 10% volume growth, and if they maintain even a 10 to 11% volume growth, they are pretty much close to the guidance. EBITDA margins which they are talking about is 15 to 16%. I think that they will be able to achieve that. We are not seeing any further cost increase happening in the industry, or on the contrary, we are seeing the gas prices are only likely to come down. So we do not build any cost pressure, and a price increase can only improve the margins. So we do not see that there is any serious risk to the earnings, and I think that the downgrade is more to do with the earnings downgrade rather than any change, longer term change in the view of the company or derating of the stocks.
And your top pick in this space would be?
So I am just being cautious right now, and that we are saying that entire building material space in my view is looking quite a lot of stressed, and that even we are saying that even pipes companies also like Supreme Industries and all, and now even in our tiles companies also Kajaria. So we are definitely building a pressure in real estate sector. The competitive intensity in the sector still remains high, so we are just suggesting our client to probably look a better price point entry for these stocks rather than jumping at these levels.
Okay, Rohan, we'll leave it at that note. Appreciate you joining us today and taking us through what you've made out of Kajaria Ceramics numbers, which were in line, but it was the guidance, I believe, which spooked the markets. The stock's been down over the last 6 sessions. I was also looking at what overall brokerages have to say, and the 12-month target price of this one is 613, which is giving you return potential of nearly 30%, and majority of the brokerages have been positive on this one. 61% have a buy call, and almost 35% of the brokers have a hold call. Only one brokerage having a sell call on Kajaria Ceramics, guys.
All right, many other stocks actually which are losing about the similar amount. So Group Finance for one is down 7.5%. Orient Cement almost 7% there. JSPL 7% plus. M&M Financial, the big one there, actually that's the talking point, down about 8.5%, 310, and concerns coming in across the board from various brokerages as well. Vodafone Idea, that's one stock actually that went below its face value in intraday trade and then came back right to it. So 10 rupees is where the stock is right now. Actually, for a brief moment, it had gone below that and come back. So now about 5.5% lower for Vodafone Idea. SAIL is down about 5% and Jet Airways 2 is down another 5%. So it looks like yet another day where we are going to see a disappointing close to the session. Dipan Mehta of Elixir Equities is joining us on the show right now. Dipan, thanks very much for taking out the time. Market mood is, completely downtrodden. We've got a lot of people sitting on the sidelines. Advice is that you would rather sit on cash right now than have some full deployment in a market like this. Would you agree? Would you see some green shoots even in this fall, considering that we're already about 700 or almost 800 points now since budget?
No, see, there are no green shoots which are visible, but conventional wisdom is that whenever you have a bear market like this, and it's been there for quite some time now, this stealth bear market has been around for more than a year or so, and these bear markets do come to an end, and if you invest in times of distress like this, about 12 to 24 months from that point, one has realized very good returns. But there are two questions. One is the conviction to buy in these markets and then have the patience to see prices drift even lower and hang in over there. And second is how much cash is there in the portfolios of investors. And the second question is even more important, because although intuitively you want to buy into stocks, they've corrected 50-60% and underlying business model, at least long term, remains sound. The question is whether you still have cash in your portfolio, and there are very few investors who have that kind of cash liquidity available to invest. Most have not been able to exit out of the market at the highs, and I'm not talking about traders but broadly long-term investors, and that really is the problem, that investable surpluses are low, and incremental flows which are coming through savings or any other means, there is not full conviction that this is the best point to buy. You could buy and then see prices drift even lower. So that's where we are at this point of time.
Okay, Dipan, stay on. Just management interaction with Praj Industries, and then we'll get back to this conversation as well. In fact, would want your view on this one too. They've reported their numbers, a 10% rise in revenue for the June quarter, but the operational picture has looked even better. Net profit numbers have jumped about 2.5 times. Let's get into Managing Director Shishir Joshipura, who joins us right now on the phone line. Mr. Joshipura, good having you. Thanks much for joining in. Some of the quarter for us, the operational performance seems very, very heady. But what about the top line growth? How has the quarter been? What is your outlook for what the next 2 or 3 quarters hold in store?
Good afternoon. Thank you for your kind comments. The first quarter traditionally in our business tends to be on the softer side. So no surprises there. I think the fact is that for the last 4 quarters or so, the country has seen a fairly conducive policy environment for the bioenergy business space, which is our core business. So obviously that has really helped us to build the performance that we have delivered. Having said that, I think the first quarter itself saw very different dynamics at play, obviously because of the elections that were being held. So that led to very different market dynamics. So we actually saw a change in pace in that on the negative side for the market finalizations, very, very different pace compared to what was already getting built up. But on the good news front, we see that coming back now that there's certainty in government, the same government has come back, so there's continuation of policy. We expect that as we progress through the year, we will only get better from here. So that's broadly the overview.
Okay. The commentary that is coming in, not all of it would have become law, but the commentary that is coming in seems to suggest that the government and the minister is extremely focused on ethanol as a biofuel. I mean, one comment that came in suggested that maybe ask the sugar companies to not make sugar but make ethanol. So the focus of the government seems to be there. Would that ensure that, if anything, the order inflow should not be a concern for a company like Praj?
Well, yes, the policy is moving very, very, very supportive, and the fact is that this does create an alternative route for farmers to continue to get their income, for government to combat pollution. There are many dimensions to this, which government is clearly seeing the interlinkages, and that is how the big push and support is coming, and direction as well from their end. And we expect that if that happens, obviously it has to translate into somebody setting up capacities. And I was mentioning earlier that there is about 6.2% blending that has happened now in the country, which means something like 200 crore liters of ethanol being blended. If we have to reach the 10% target, which is the interim target government has set, we are looking at almost equal capacity being added, in terms of crores of liters. So yes, there is a positive environment, and this now needs to translate into what I would call as the commercial reality as well.
Okay. By the way, Jubilant numbers are out on the screen. Net profit is very flat, so keep that at the back of your mind, down about 3%. Mr. Joshipura, what's your prediction about what you would do on the operational and the bottom line front going ahead? Quarter one showed a meaningful spike, both in EBITDA margins, moving from 2.2 to 3%, as well as the bottom line numbers jumping up 2.5x. What's the guidance for the rest of the year?
No, we would not issue a guidance in terms of what the numbers would look like, except to say that we believe that the market forces have been positively moving over the past 4 quarters, except the exception of the last quarter, which was slightly on a different tone given the electoral environment. But it's sort of come back, and so we expect that this journey will continue.
Last question. You had qualified for 4 out of the 6 projects so far planned by the oil marketing companies. When does that result in substantial order flows for you or business opportunity for you?
Yes, great question. So of the 4 contracts, one has moved to a stage where we have received substantial portion of our order from them. We have not executed them yet. They're under execution. On the licensing and engineering front, we have executed the 4 jobs. But on the equipment supply side, we have received the part contract for one of them. The other 3 are still in the process. And we expect that as the year progresses, we'll probably see the order book happen. But the execution will probably be over the next 18 months or so.
Okay, we'll leave it at that, Mr. Joshipura. Thanks so much for taking the time out and being with us today and giving us your perspective. All the best for the quarters ahead.
Thank you. Thank you.
That's Jubilant Foodworks. That's Praj Industries, of course. Now, Jubilant Foodworks numbers on your screen. The operational numbers looks okay. We're waiting for the same-store sales growth number because I think that will be the determinant of what the stock does going ahead. For now, it is correcting about 2.5. EBITDA at about 219, and net profit at 74 crores versus 74 crores. So the bottom line number has stayed absolutely flat. Revenues have grown about 10% odd. Same-store sales growth numbers, I'm just waiting for that. Numbers marginally below estimates, I would reckon, compared to the Bloomberg polls, and which is why you're seeing the stock being down about 1.5%. But I dare say this one will move on the back of what the same-store sales growth numbers look like. I think the expectation is about 5%. Let's wait and watch if that comes about or no. But 10% revenue growth.
I think there is some major adjustment with regard to Indies this time around for Jubilant. They've shown a finance cost of 40 crore, and we've not seen that in the last quarter or also on year-on-year basis. And that, of course, we know that the adjustment is also got to do with the lease rentals. So we are seeing a substantial reduction in the rent cost, which is 21 versus 85 crore. So I think that finance is coming out of that rental, which is looking lesser for the quarter. We'll wait for the clarification, but in the press release, management has clearly highlighted that the numbers may not be comparable to the previous quarters because of this adjustment. So there's a fresh item of finance cost, which is somewhere about 40 crores, and the rentals have gone down to 21 crore.
Dipan Mehta is with us. Dipan, what do you make of these numbers? We're of course still awaiting the same-store sales growth numbers, but these consumption names and one after the other, different facets, staples, discretionary, and now the QSR space and the Jubilant numbers that have come out, revenue growth of about 10%. Don't have the same-store sales growth numbers, so can't help you with that.
Yeah, I think that broadly there's disappointment around most consumption-oriented stocks, and the kind of slowdown which we have seen in autos. It started with that, but now it's percolating to many other industries and even basic consumption items like soap, detergents, and to an extent even pharmaceuticals. We are seeing that demand has certainly waned, and we are seeing lower consumption, and I think that has confounded many experts within the sector, and something which they have not seen for many years. This kind of synchronized slowdown in spending, difficult to get a handle on, and whether it's structural, cyclical, and when it will reverse. I think these are questions for which we have no answers as of now. All that one can say is that hope for a good monsoon, and if RBI further cuts interest rates and that transmission is there through the banking system to the average borrower, the retail borrower, then at some point of time around this particular festive season or early next year, you could see consumption pick up. But yes, at this point of time, I think across the board we are seeing demand being impacted in most industries. And there could be a few outliers that maybe say Asian Paints, which seem a good set of numbers. But by and large, I think anything to do with retail, whether it is consumption or lending, has certainly come off significantly from the high growth rates which we saw right through last year.
I think the EBITDA margins are, a factor to highlight. Expectations were that they will come in at 17.1%. The EBITDA margin has come in much higher on the operational performance, 22.6%, 22.9% with regards to the margin expansion on that front. That's why I think you've probably see the stock picking up from the lows that it hit just a few moments ago. But again, the crucial aspect, like everyone's been saying, is about these same-store sales growth numbers. It's a far cry from the earlier 20s that the stock used to enjoy and the company used to enjoy to 6% in the last quarter, and that's exactly where you're going to be expecting it to come. And like Kaustubh said, that if you do manage to see a 5 to 6% same-store sales growth for Jubilant Foodworks this quarter, that's probably not a bad number to go by, according to him. So 1194, that's where the stock's currently trading at. But let's bring in our technical experts as well. Manav Chopra, he's joining in right now from Indiabulls Ventures. Along with him, Ruchit Jain of Angel Broking is also joining in. Gentlemen, thanks very much for taking out the time, the both of you. Manav, let's start off with you. 11,1265, I believe, is where the index is currently perched at. What kind of a strategy would you deploy?
See, at the current levels, the markets have already seen a series of decline from its recent peak, and looking at the overall oscillators on the daily charts, we have entered near the oversold levels. So currently, on the index front, I don't see much of a downside. Maybe 11,200 or 11,150 are the important support levels for the markets, and a likely zone from the markets to at least could see a near-term bounce for a very short-term perspective. So at the current juncture, I think it's important that one can still start looking at a very selective short-term trading opportunities or buying at the current zone. For the near term, I think the broader range for the markets would roughly be around 11,200 on the lower side to 11,600, 650 on the upside. Even for the bank nifty, 28,800 is a very important support, and looking at most of these stocks in the banking space which are near its oversold levels, I sense the markets are near to important support clusters where a short-term bounce is quite likely for the markets in the near-term perspective.
Okay, stock ideas then?
Yes, so my first buy call is on SBI. In fact, we've already seen the stock decline from its recent peak of 370, and it's nearing to its important support clusters of its recent gap pattern. So at the current juncture, the stock is also trading near its important weekly support levels, and the high time frame chart still remains on a positive zone. So looking at this parameter, I think this is a mean reversion for the stock in a larger time frame. We recommend a buy into this with a stop of 330, and we expect an upside target of 365. My second call is a sell on Shriram Transport Finance. In fact, the stock has breached its weekly support levels decisively with above average volumes, and it's currently trading below its important crucial support zone. Expect some further sell-off into the stock and could test its important swing low. So a stop loss of 916 Shriram Transport Finance for lower targets of 870.
Okay. Hi Ruchit, good afternoon. First view on the index. We continue to grind lower, now trading very close to the mark of 11,250. Would you take any fresh bet from current levels?
Yeah, hi, very good afternoon. Well, if we see the short-term trend for the market still continues to remain negative, as after the recent high for around 11,700, we have seen that the index is corrected from those high, and this is the fifth trading session where even the previous day high has not been crossed yet. On the lower side, we expect this correction to continue towards 11,150 to 11,180 range, where there is a 200 DMA on the 200 days moving average, as well as the 100% extension of the previous correction. So our stance is that we would see some further correction in the markets. 11,180 to 150 would be the range where if any existing shorts are there, then that could be covered around those levels. For fresh shorts, we won't be recommending fresh longs, fresh short positions over here because the risk reward ratio won't be much favorable. The near-term resistance is seen around 11,400, so the risk reward ratio is not favorable for creating fresh positions, but any existing shorts should be held on for target around 11,180 to 150 range.
Okay. What about your individual stock bets, Ruchit?
I have one buy and one sell recommendation. Buy recommendation is on Power Grid because this has been one of the outperformer in the recent past. We have seen that in spite of so much correction in the broader markets, this stock has managed to hold near its 52-week high. Now, in the weekly chart, the prices have recently given a breakout from its resistance, and after consolidating in a range, the volumes are still good. So we are expecting continuation of this outperformance. One can buy from a short-term perspective with stock below 202, expecting target around 224, and Havells can be looked for a shorting opportunity. The stock has breached its 200-day moving average in today's trading session. In the morning, first hour of the trade, when that support was breached, the volumes are quite high. A pullback move has been seen in intraday, but again, that earlier support of around 700 is now acting as a resistance. So one can go short on Havells with stop loss below above 718, expecting target around 668.
Havells has actually seen quite a sharp correction in the matter of a few days, where the stock had initially come down to levels of about 710, but then bounced back up to levels of about 728, 730, and now the final straw getting pulled out below that mark of 700, 693 on Havells India right now. In the last 1 month, the stock's dropped about 12% and Ruchit envisages further weakness in that particular stock. Dipan, while we're talking about FMCG, what about FMEG? Some of these companies, Havells, Polycab, do they bear the similar impact that you would see? I mean, ultimately, they're a part of the consumption basket, and they would attract, the same kind of, what do you say, the consumption flavor still sticks to these two as well. So would there be pain in these companies like Havells, Polycab as well?
Absolutely. I think I would be a bit cautious at this point of time, and the kind of slowdown in consumption we are seeing, I think it's all pervasive, and even if select managements and select segments within the consumption basket are doing well, it doesn't mean that slowdown cannot come over there. So I know that Havells has been reporting good numbers, especially as far as the cables and some of its appliances are concerned, and same is true for even Crompton Greaves consumer. But you have to see these numbers with a little bit of suspect, because going forward, certainly I think some sort of slowdown will definitely affect them. And if they are trading at high valuations as Havells is at this point of time, then that doesn't make sense to at least make incremental investments into such companies. So I think in times like this, capital protection is of paramount importance, and investors are looking for safe havens. Could be utilities companies, or it could be some of the other maybe export-oriented businesses. But I think at this point of time, anything to do with consumption has to be seen with a little bit of suspect, because you could certainly have a slowdown over there. And then when you have a slowdown, what happens typically, and what we have seen in the numbers so far, is that negative operating leverages start coming into play. So while the company's revenues are up by only 4 or 5 or 10%, but we see flat to declining profits because the costs keep on increasing at the underlying business, and doesn't get absorbed in the revenue. So that's another risk factor we need to consider.
Some of these stocks, really, the way they've fallen, all of them at their 52-week lows, and in fact lows in which we've not seen in years. I think Eicher Motors also at 52-week low, today also down about 4% 16,364 on Eicher Motors. One stock, however, that is bucking the trend today, and that has been Zee. Operational performance has been an upbeat number. You've seen that outperformance coming in there, and also some commentary with regards to the stake sale and the binding agreement that the management has. They have one, the other one is on its way, and when the management, Puneet Goenka, spoke to Yatin in the morning, his conversation with him almost seemed to suggest that it's a matter of a few days when the second binding agreement would be on the table, and he'll be able to share more details with us. 381 for Zee, 5.5% higher. What do you do right now, Ruchit, with Zee?
If you see last, I think 3 or 4 weeks, the prices were consolidating in the range of 368 to 328. And today's trading session, in spite of the market's negative momentum, the stock prices have managed to give a breakout above that 368, and that too with increase in volumes. So I think this should lead to some further pullback move, maybe towards this 200-day moving average, which is placed around 410. So the biasness, at least for short term, continues to be a little on the positive side. Although it's not an uptrend, it should be just considered as a pullback move until we see a sustained move above its 200 DMA. But from a very near-term perspective, the stock could test levels around 400 to 410.
Okay, that's about Zee, and we've seen Berger Paints also moving higher after Asian Paints came up with the numbers, and Berger Paints has seen gains of about 1 to 1.5%. Just pull up Jubilant Foodworks. I think the press release has come. The same-store sales growth number is the one which will be in focus. So far, I think, Domino's same-store sales growth at 4.1% on a base of 25.9% in the same period of last year. By now, we know that the benign phase of low base is over for all these companies. So I don't know if you should compare it on year-on-year basis, but look at the last quarter, it was 6%, and now the same-store sales growth number, as reported in the press release of Jubilant Foodworks, is at about 4.1%. So it's coming off what even the street was expecting, and the clear reaction can be seen on the stock price, which is sitting with cuts of about 3%. Last quarter was 6%. Quarter before that, they've been registering double-digit volume growth, same-store sales growth for this one and for other FMCG companies. There was a phase for straight 5 5 quarters we were seeing double-digit growth coming in because of a low base, which phase of that is now over, and look at that, the stock's reacting quite sharply. It's down now 8%. Neeraj, I remember chatting the other day when I think there was some street chatter also with regard to how low the same-store sales growth number could be for Jubilant Foodworks, and I think it's turning out to be a reality now.
Yeah, well, 3% expectation, then suddenly people said it won't be 3%, and now it's a slightly better number than 3%, 4.1, but it's certainly showing in the way the stock is correcting, and this is not surprising really, 1131. Let's wait and watch what happens going ahead. Look at that, look at that, look at that coming off the peaks for Jubilant. It'll be interesting to see what Yum Foods or what even McDonald's, which is Westlife, have to report when it comes to their SSG, but this is not a very pretty number. Just a quick trade perspective here because it's falling thick and fast. Manav, would you trade Jubilant?
Is that for me?
Yes, Manav.
Yes. See, if you're looking at the prices in the last couple of trading session, it was holding on to its important support of 1200, and the kind of a decisive breakdown that we witnessed in just a few hours of trading sessions, it's clearly indicating that the prices have reached its important weekly support zone, and this could definitely see some more selling pressure for the stock in next couple of trading sessions. I believe if anybody is holding on to its long position, so definitely exit, and even one can look to initiate short position, but the stop losses would be little deep in this. I think as long as the stock trades below 1165 for next few trading sessions, there is a high likely chance we could see the levels of close to 1020, 1025.
Okay, that is Jubilant Foodworks, and clearly a big disappointment, dragging the stock lower to about 1100 odd levels. Remember the premium that this stock attracted within this space at the time when it reported same-store sales growth of about 25 to 20 odd percent. Probably you'll start to see that normalize in the next few quarters once that high base effect starts to wear off, but that doesn't seem to take away the pain that we're witnessing as of now on the stock. So right from quarter 4 of FY18, from a peak of about 26.5 to 4.1, where we've seen it at, and despite what you see with regards to the overall other lines of operational performance, whether it be due to some certain accounting changes that have happened which have shown up in terms of their costing going down, or whatever that may be, it is this number that is clearly taken center stage and disappointed the street in a very meaningful way. 3.2 million shares actually should see that the volume function as well, the AVAT function, to see how the volume has shaped up on the back of this drop, this pricing drop that we have seen on Jubilant Foodworks. So 1133 now and sinking fast, and that's the AVAT. As soon as the same-store sales number got reported, that big spike in volumes has come about for Jubilant Foodworks, and that big sell-off in the counter, bringing it down about 8 odd percent, and that's what you've got right now. And I don't see it stopping as of now. So now it's down about 97 points, 98 and counting. But that is Jubilant Foodworks. Dipan, you want to come in? 4.1% same-store sales.
Yeah, extremely disappointing set of numbers, and I think the cup of who's just is not overflowing over here, and we are getting more and more bad news. I think if we had some amount of bad news a few weeks ago, this earnings season is turning out to be a complete disaster, and with this kind of numbers, I think one really wonders how long it's going to last, this particular slowdown that we are dealing with. And if you notice the entire spectrum of industries, there's hardly any place to hide, I think, except for maybe cement, where we are expecting positive set of numbers, and maybe engineering construction companies. I think broadly most other sectors are undergoing a lot of stress, and even software, which was doing well until last quarter or so, we have seen a lot of disappointments in mid-cap and large-cap software companies as well. So what we are seeing right now is a classic bear market, and it's being affected largely by economic slowdown as well. And although steps are being taken by the RBI and by the government, it'll be at least a few months before the industry revives and demand revives, and hopefully we'd have an end to all this liquidity crisis related issues, and only then can we see the overall improvement in the stock markets and the broader economy. So I think these are tough times for investors, and I think bad news is in companies being punished in a very harsh manner, as we have seen in the case of Jubilant Foodworks. And all I can say is that we just need to ride out these trying times and remain invested. I think the time to book profits, I think has that particular bus is already gone. Doesn't make sense selling a good quality blue chip company after it is down 30-40%, especially when you are confident that over a longer period of time, 3 to 5 years or so, the underlying business momentum will pick up and the underlying fundamentals are very strong.
All right, Dipan, we leave it at that. Thank you so very much for joining us this afternoon with your thoughts. Jubilant Foodworks, remember, last 4 quarters enjoyed a price to earnings multiple of about 50 times plus. Now, for FY20, estimates are closer to about 40 odd times. So, and you'll probably see that in the price performance as well. We're going to take a very short break on that note. Jubilant Foodworks is down about 7%. Trying to recover from the lows, but on the other side, we'll get you the closing strategies, we'll get you the Fab 4 stocks of the day. Stay tuned.